Hi guys, today we are going to present our topic is the association between dividend changes and company earnings. Before we start our presentation, I would like to introduce to all of you our group members. My name is Syed bin Syed Managing.
My name is Dajika Pei. My name is Shao Wenxi. My name is Nudayana Afifa.
My name is Position.
I'm Nudayana Afifa, a reporter from BWFF. A company usually make their dividends payout based on dividend policy in the company. An effective dividend policy not only able to attract investors and stimulate fund-raising activities from the stock market, but it also can help the companies to cater their future investment needs. The association between dividends, decisions, future investment needs, and company earnings turn the dividend announcement as one of the source of investors to access the company's future prospect. However, setting an effective dividend policy is quite difficult as the companies need to take many conflicting factors as consideration. Other than paying dividends to signal financial health, the managers of company also has to consider the company's long-term financial goals and shareholder value maximization. Therefore, it is hard for the companies to decide dividend policy as the dividend policy they make will affect the amount of company's earning to exploit company growth.
The relationship between dividend change and company earnings is one of the famous open debate topics in finance. Now, there is a discussion about this topic conducted by UM students. Let us take a look.
We arrive. Now we are going to the room. Before we start our discussion, we have invited an expertise from CLB School. Now she will introduce some of dividend policy theory.
Hi. Firstly, I want to introduce the dividend signaling theory. In the real world, undeniably, the investors have data reliable information to evaluate the firm's profitability or its growth prospects. The investor may assess or determine the firm's performance by using the audited financial statements. However, all these financial statements only record and may use to evaluate the firm's past performances, but it does not actually tell the investor about the expectations on the firm's future performances. Therefore, the investor will tend to find clues about the management's belief on the firm futures through the signals like the dividend changes from the management regarding its expectations on the future's earnings.
The dividend model, which developed by the Lynott 1956, proposes that the firm should set a long-term payout ratios and adjust it slowly over time. The firms will only increase its dividends to signal its investors when the managers believe that the future cash flow would support the higher dividend rate. Besides, Bhattacharya 1979 also further developed a model in order to explain why most firms select to pay dividend even there is a tax disadvantage. Due to imperfect information about a firm's profitability and information such as accounting data that is not fully reliable for outside investors to assess or determine a firm's profitability. He describes that investors are willing to pay higher tax if they receive the favorable signals that the firm will have greater value in future regardless the conditions where the tax rate on the dividend is higher than that of the capital gains. This suggests that the dividend has been used as a useful tool for the investor to assess a firm's future profitability. Now I would like to continue with the agency cost and the free cash flow theory. This theory is developed by the Jensen and McLean 1976 to investigate the agency problems between the firm insiders and the outside investors. They state that the agency problems arises from the free cash flows. Agency cost is a cost of conflict of interest that exists between the shareholders and the managements. Jensen's 1986 claims that the managers have the incentive to undertake some activities that could be costly to the shareholders, like making unprofitable investment which able to generate excessive returns to them. However, this also causes unnecessarily high management compensation which could erode the shareholders' interests. Besides, payments of the large portions of the earnings to the shareholder and the subsequent issues of the debt will also encourage the monitoring of the firms by the third parties like the banks and the credit institutions. Therefore, the firms will only increase the dividend payout if they are sure about the capacity of maintaining high level of dividends payments and they are able to produce positive cash flow and generate profits after that, as they realize that they will be monitored by credit institutions. Our free cash flow hypothesis has suggested that the dividend increase announcement should be accompanied by positive stock market reactions because agency problems will be reduced and investors believe that the dividends pays out is able to reduce the potential over-investment problems. On the other hand, dividend decrease should also be followed by the negative market reactions, as this may indicate that the firm will misuse the excess cash into unprofitable investments.
Thank you for sharing. So, the discussion will start now.
As we know that increase in dividend payout will also signal high level of management confidence toward the stability and growth of company earnings. The management will not increase its dividend payout if they are not certain about their future capacity. Do you think a firm will increase its dividend payout if they think that they are unable to generate sufficient income in the future? Certainly not. This will only put them at risk since they need to increase the dividend payout while they expect that they will have poor performance in future. Besides, Amod and Esnes at 2003 also conclude that dividend change was positively related with future earning changes. The results show the growth of future earnings tend to be slow when dividend payout ratio was low, and the higher the payout ratio, the greater the earning growth. The researcher has found a possible explanation to the positive relationship. One of the explanations was corporate managers are willing to cut down dividend payout because high dividend payout ratio will signify managerial confidence toward the stability and growth of company future earnings. The result of signaling effect can be discovered through research taken by Gold, Mount, and Wilson at 2015. They investigate the relationship between dividend change and company future profitabilities and found that increase of dividend was positively related with company future earnings. This result was consistent with dividend signaling theory, which suggests Increase in dividend will signal positive future earning changes.
Yes, I do agree with your point. For most of the firm, they will only increase its dividend payout after realizing its capacity. But one point I want to insist here is a firm which do not increase its dividend payout doesn't mean that it does not have capacity. According to Moses and Rabashori, they found that the dividend decrease may not provide a negative signal about future earnings, probably because small dividend decrease may represent the company attempt to keep resources for future growth opportunity or make decisions to solve financial problem. They also provide evidence decrease in dividend provide a significant improvement in profitability as well as financial and liquidity ratio. As a result, share price of the firm increase could occur in the dividend decrease announcement period.
There was another study conducted by Nizin and Z 2001 using regression analysis to investigate the relation between dividend changes and company future profitability. They found that increase in dividend has positive relationship with company profit in each of the 4 following years. However, the decrease in dividend was not related to company future profitability, and they suggest that this was due to accounting conservation.
Sorry for interruption. Based on payment and sojourners, they found that dividends are negatively related to subsequent earnings after controlling for current dividend price, earning and book value. The study showed that controlling for current earnings is consistent with the accounting concept of conservatism, and the dividend will decrease in explaining in future earnings. Loss should be recognized in earnings when anticipated, whereas profit should be recognized only when earned. As a result, current year earnings cannot contain the future implications of the good news that caused the company to increase the dividend. On the other hand, future implications of the bad news that trigger the dividend decrease should be reflected current earnings.
Okay, thank you. Besides, there are also another study which is carried out by Fatima Tafani and Muhammad Abdullah at 2014. The result of study revealed a significant positive relationship between the dividend payout, return on asset, and return on equity. The findings indicate the companies that increase their dividend payout will experience increase in their profitability, while dividend policy will emphasize as a major factor to affect the profitability of manufacturing company listed on Colombo Stock Exchange. This study further recommends the company's earnings will fall with the increase of debt capital in capital structure and increase when there were growth prospects for the companies.
However, Tehon and Kidd have found a negative correlation between dividend change and company performance by suggest that a company dividend yield, debt to equity ratio, and current ratio have an effect on the probability that the capital market will react negatively to an initial dividend announcement. The incremental of dividend, which is the payment of a larger than expected dividend, may signal that the firm does not have any available investment opportunity that will sustain the earning growth, and the capital market will lead to negative reaction. Inversely, the reduction of the dividend, which is a smaller than expected decline in dividend, may signal that the firm has available investment opportunity that will sustain the earning growth, and the capital market will react positively.
Effect of dividend payout ratio on company future earning growth, also investigated by Basangi and Vijay Singh at 2016. They found that the dividend payout ratio has a positive relationship with company future earning growth, and this relationship was significant at 1 year period. Besides, the relation between dividend payout ratio and growth of future earnings for 3 years also showed a positive relationship, but it was not as significant as the relation in 1 year period. Besides, Adediran and Elliott at 2013 also determined the relationship between dividend policy and company profitability, investment, and earning per share. The finding revealed dividend policy was positively related with company profitability, investment, and earning per share. The researcher recommend companies to have a good and robust dividend policy to improve their profitability and also to attract investment for the companies.
Okay, thank you. This is my last point. Based on Fillon, Raymond, and Ramirez, also found that there's a negative relationship between dividend change and company earning. They have highlighted a positive sample misclassification arising from the use of net dividend model that does not really distinguish between expected and unexpected dividend change, and propose the use of dividend expectation based on analyst forecast. The results show that if the dividend decrease is smaller than forecast by analysts, the market may react positively. In contrast, if the dividend increase is smaller than was forecasted by analysts, the market may react negatively. The dividend remain no change may also lead the market react negatively or positively, which depending on the dividend forecast.
The discussion. Besides these two relationships, there are also some studies stated that there is no relationship between these two variables. Now, I would like to invite another expertise to explain further.
For the no relationship between the association between dividend changes and company earnings, first of all, there are several studies argue that dividend changes has no relationship with company earnings. According to the research has been done by Facio, Gary and Moser 2004, there was no significant relationship exist between the earning and dividend in the long period. This analysis is based on the quarterly dividend and earning S&P 500 index between 1998 to 2002. The result will strongly support the hypothesis of dividend changes has no explanatory power to predict the company future earnings. They argue that the previous study that conclude positive and negative relationship were based on the short-term period and misleading potential investor. Thank you, Gruller, Michelle, Bernazzi and Taylor 2005 also found that the dividend changes are not correlated with future earnings. The study was conducted based on this company that listed in the New York Stock Exchange and American Stock Exchange from 1963 and 1997. The analysis of this study include that the dividend changes did not outperform and even underperform the model. They exclude dividend in most cases. Therefore, this shows the dividend changes are not reliable predictor of future earnings. Thus, dividend changes are uncorrelated with future earnings. However, Lim 2008 will also argue that there is no significant relationship between the dividend changes in current year between the future earning changes. This analysis is obtained from the DPS and EPF in listed company from Bursa Malaysia from 1997 to 2007. This study summarizes the reason why dividend changes cannot predict the Malaysia company future earning due to the unpredictable future earnings and the fulfillment of the shareholders on their investment return as their source of their income, and Malaysia investor generally more concerned on their share price rather than share dividend. According to Lee, Isa and Lim 2012, dividend changes had insignificant relationship with changes in earnings beyond 1 year. This result have consistent with the Lim 2008 research. Besides, they also found a weak evidence to support the relationship between the dividend changes and the dividend stability with future earnings. Besides, Rosinas and Jaber 2016 also conclude that dividend changes cannot be used to explain the future earnings and were not reliable to predict future earnings. The result of the study showed that changes in dividend was positive correlated in the next year but negative correlated in earning changes in the following 2 years. The differences between the result have made the study fail to support positive significant relationship between the dividend and future earning.
Not strong evidence in determining whether the relationship between dividends change and its future earnings are positive, negative, or non-related. However, investors still tend to use this information to indicate the future performance of the company since they do not have management assessment of firm future profitability. As investors, they should also realize that there is always risks and uncertainties in the capital market which will affect the future earnings from time to time, no matter how the dividend changes, as have conveyed the information regarding the future firm performance to them. For instance, smart investors should always examine and analyze external factors such as economic, political issues, which will also lead to unpredictable change in the future earnings.